Yesterday, oil did exactly what it always does when retail FOMO meets a geopolitical headline. It ripped to 112.50 before Trump said 4 words that vaporized the bid, holding off on attack. $3 of premium gone in hours. And the pattern left behind is a textbook bull trap if you're holding longs from the highs, or if you're sitting on the sidelines wondering whether this dip is a gift or the beginning of something much nastier. Stay with me. There is one danger zone and one hidden opportunity today. I'll show you both. Write this number down right now, tape it to your screen. If Brent breaks and closes above 112.50 on a daily time frame, the entire bearish thesis is invalidated and we chase momentum higher. Until then, this is a fading exercise and the trapdoor is still open. Here is the instant market verdict for Brent crude today. The session bias is a fading rally within a structurally bullish but exhausted trend. The 1-hour chart has flipped neutral, the 5-hour remains overbought but rolling, and the daily and weekly are screaming strong buy. That means we are in a consolidation phase where counter-trend scalping and intraday selling at resistance works, but the dip buyers are still alive below. The breakdown level that proves this bias wrong is 112.50, with a 1-hour close above it accompanied by rising volume. If that happens, the trap becomes a launch pad, not a coffin. But until we see that, every rally into the 110.50 to 112.50 zone is a potential distribution event. Type 112.50 in the comments right now, just that number, so I know you're locked in and watching the same line. This is your anchor for the entire session. Now let's walk the charts top to bottom, because the higher time frames tell you the war, and the lower time frames tell you the battle, starting with the weekly canvas. Brent is in an unbroken strong buy sequence. Price sits well above the 20-week moving average at 98.40, the 60-week at 92.10, and the 200-week at 84.70. The slope of the 20-week MA is accelerating upward, and the weekly MACD is printing higher histogram bars above the zero line. This is not a chart that wants to collapse. The long-term trend is your friend. The weekly support floor is 104.20, which lines up with the prior breakout level from March. That zone is the structural line in the sand for bulls. Lose that, and the weekly trend begins to crack. For now, the weekly shows we are only seeing a pullback within a raging bull trend. Drop to the daily chart. The daily remains strong buy, but look closer. The 20-day MA is at 104.80, the 60-day at 100.40, the 200-day at 96.20, all sloping higher, perfect bullish alignment. However, yesterday's candle is ugly. After making a new high at 112.50, sellers hammered it back down to close near 109.70, leaving a massive wick on top. That is clear price rejection. The daily MACD, while still bullish, has a histogram that is losing altitude. We are seeing early signs of negative momentum divergence. Price made a higher high versus the early April peak, but the MACD histogram failed to match that high. This is a warning that buyers are fully exhausted at these elevated levels. The daily support to watch is 106.80, the most recent swing low before yesterday's sharp spike. Daily resistance sits at 112.50, then 115.00, the key psychological round number and April supply zone. The daily battle is crystal clear. Above 112.50, the bull trap is negated and we target 115. Below 106.80, the trap is confirmed and we accelerate toward the 20-day MA at 104.80 and the weekly floor at 104.20. Now the 4-hour chart, where real short-term bearish pressure becomes visible. The 4-hour trend was strong buy until yesterday's sharp drop flipped it fully into neutral territory. The 20-period MA on the 4-hour is at 108.10, the 60-period at 106.20, the 200-period at 102.50. Price is currently hovering just above the 20-period moving average, meaning bullish momentum has completely stalled. The 4-hour MACD just printed a bearish crossover, with the signal line turning down and the histogram dipping below zero for the first time in 5 trading sessions. This is the first genuine 4-hour sell signal in 2 weeks. The short-term impulse has officially shifted to the downside, Expect the 20-period MA to act as strong overhead resistance, and a clean break below it will accelerate a slide toward 106.80. A confirmed breakdown below 106.80 on the 4-hour chart opens the door straight to 104.80, where large scale dip buying algorithms are waiting for entries. 4-hour immediate resistance is firmly at 110.50. Finally, the 60-minute chart. The hourly trend is fully neutral, meaning choppy range-bound price action ahead. Hourly moving averages are tightly tangled. MA20 at 109.20, MA60 at 108.50, MA200 at 106.80. Notice how the 200-period hourly MA perfectly matches our key daily support level, forming a powerful multi-timeframe convergent support zone. Price is coiling between a declining resistance trendline extended from the 112.50 peak, currently sitting around 110.20, and solid horizontal support near 109.00. The 60-minute MACD remains flat below zero, struggling to stage any meaningful bullish reversal. Any rejection here confirms sellers are building short positions. The hourly structure has formed a classic descending triangle pattern. The measured downside target of this triangle, once 109.00 support breaks, lands right at 106.80. All technical signals point toward one simple fact: a liquidity hunt down to 106.80 remains the path of least resistance, unless buyers can reclaim 110.50 and force a breakout above 112.50. Here is what most retail traders completely overlook. You cannot trade oil in isolation. Cross-asset correlations reveal the real market sentiment and hidden trading edge right now. First, gold acts as the main fear gauge in the current market environment. While oil crashed hard on Trump's de-escalation headline, gold prices held steady near recent highs. This is a major divergence. If geopolitical risk premiums were truly evaporating across global markets, gold would have sold off heavily as well. This price behavior proves the oil sell-off is not purely driven by easing tensions. It is mainly an overbought technical correction after markets fully priced in immediate military conflict. Gold's resilience sends a clear message to oil traders. Safe haven demand is still alive. It has only rotated to other assets temporarily. If gold keeps holding firm while oil dips deeper, this creates high-quality buying opportunities for crude oil, as geopolitical premiums are only being repriced, not eliminated entirely. On the contrary, if gold collapses alongside oil, it signals a broad risk-off shift, and oil will face far deeper losses ahead. Always keep a close eye on gold futures price action. The second key correlation is the US dollar index. The dollar edged slightly higher following the Iran conflict de-escalation news. As a primary safe haven currency, a stronger dollar also reflects easing inflation expectations triggered by lower oil prices, which in turn lift real yields. A persistently strengthening dollar creates strong headwinds for all commodity markets, and Brent crude is highly sensitive to dollar strength. A sustained break above the 106 level on the DXY will place consistent downward pressure on oil prices. Thirdly, track equities markets closely. The S&P 500 rallied sharply on the no immediate attack news, as risk assets welcomed reduced geopolitical uncertainty. Oil's recent drop is partially driven by capital rotating out of commodities and into stocks. If major stock indices start giving back recent gains, market sentiment will shift back towards safe haven hard assets, and oil will quickly regain bullish momentum. The next 24 hours will be a three-way market chess game between gold, the US dollar, and global equities, with crude oil sitting right in the middle of all flows. Now we move to core fundamental drivers. The dominant 24-hour news catalyst is straightforward. Oil erased recent gains after Trump officially confirmed he is holding off on planned military strikes against Iran. Financial markets had fully priced in massive supply disruptions across the Strait of Hormuz, with many institutional trading desks estimating roughly $10 worth of geopolitical risk premium had already been baked into Brent prices. This risk premium instantly shed $3 within minutes after the official statement. Nevertheless, the full risk premium has not disappeared. Geopolitical tensions in the Middle East have only been delayed, not resolved completely. The 1 to 2 week overall directional bias remains bullish as long as price holds above the critical 104.20 support level. Tight global crude supply and demand balances, strict production discipline from OPEC plus member nations, plus the potential for sudden reignition of Iran-related tensions all provide solid fundamental downside protection for oil prices. The only event that fully invalidates this bullish outlook is a confirmed daily close below 104.20. If that level breaks decisively, market sentiment will shift toward demand destruction fears and full trend breakdown, opening a long-term downside target near the 200-day moving average at 96. In the immediate short term, the most probable price move is a deeper liquidation drop toward 106.80. Followed by price stabilization and a potential bounce to retest the 112.50 resistance zone once again. This is the core trading rhythm we follow right now. Most viewers will stop watching at this point thinking they have absorbed all key information, but this is exactly where consistent trading profits are made. Below are 3 complete actionable trade setups with clear entry triggers, stop loss placement and fixed risk-reward ratios with zero ambiguity. Strategy 1. The sniper setup. Conservative high probability trade, ideal for patient traders who wait for full price confirmation before entering positions. Entry condition. Price retests the 112.00 to 112.50 resistance zone and forms clear bearish reversal candlestick patterns on 1-hour or 4-hour charts, including long upper wick rejection, bearish. Engulfing candles or pin bars closing back below 111.80. The 4-hour MACD must show fading momentum with falling histogram bars. Official entry, near 111.80 on confirmation candle close stop loss placement. Above recent spike high at 113.10, total risk equals 130 pips. First profit target, 110.00, risk. Reward ratio above 1 minute and 1.3 seconds. Second major target, 106.80 key support zone. Total reward equals 500 pips, risk-reward ratio 1 to 3.8 execution rule. Take partial profits at target 1, move stop loss to break-even level for remaining position to lock in gains. Setup invalidation. If price breaks and holds firmly above 112.50 with rising trading volume for over 1 hour, abandon all short trade ideas immediately. Strategy 2. Active intraday trader setup, designed for short-term day traders looking to trade current bearish momentum without waiting for full high retests. Entry condition. Price pulls back to the 109.80 to 110.20 former support turned resistance zone, showing clear selling pressure, paired with 15-minute bearish engulfing patterns or MACD crossing below zero. Average entry zone, 110.10, stop loss level, 110.90 above recent session highs, total risk equals 80 pips. First target, 108.40 at the 4-hour 20-period MA, risk-reward ratio 1 to 2. Second target, 106.80 major support, risk-reward ratio 1 to 4. Execution rule. Once first target is hit, trail stop loss up to 109.20 to secure profits and hold remaining position for larger downside moves. Setup invalidation. A confirmed 1-hour close above 110.50 signals fading bearish control and cancels this short setup. Strategy 3. Aggressive countertrend dip by setup high-risk contrarian strategy only for experienced traders with strict risk management rules. Use only if you remain fully confident in the long-term bullish oil trend. Entry condition. Sharp fast decline down to 106.80 on the hourly chart, forming clear bullish rejection wicks and full bullish engulfing candles closing back above 107.20. Never catch falling prices without solid candlestick confirmation. Confirmed entry price, 107.30 after bullish pattern closes. Stop loss placement, below recent swing low at 106.20, total risk equals 110 pips. First profit target, 109.00 former triangle support level, risk-reward ratio 1 to 1.5. Second target, 110.50 intraday resistance zone, risk-reward ratio 1 minute and 2.9 seconds. Critical reminder. This trade goes against current 4-hour bearish momentum, carrying lower win rate. Avoid entering this long setup if both stocks and gold are selling off heavily alongside oil, which signals broad commodity market weakness. Stick firmly to these universal trading rules without exception. Never risk more than 1 to 2% of your total trading capital on any single position. Avoid holding large open positions ahead of high-impact news events, especially tomorrow's official U.S. crude oil inventory data release. Hard fixed stop losses are non-negotiable in every single trade. Traders who refuse to use stop losses are not investing professionally. They are pure gamblers. Always protect your trading capital as your most valuable asset in this volatile market. Full session market summary. The single most influential price level for the next 24 trading hours remains 112.50. As long as Brent crude trades below this key mark, bearish corrective. Price action stays active, with 106.80 as the primary downside target. A decisive daily breakout and close above 112.50 instantly reverses the short-term outlook back to strong bullish, opening a direct rally toward the 115.00 resistance level. The best hidden long entry opportunity lies at the 106.80 multi-timeframe convergence support zone, where institutional buyers are expected to step in once clear bottom reversal signals appear. All market participants must focus closely on tomorrow's US EIA crude inventory data release. This high volatility report has the power to break the current narrow trading range completely and set the firm directional trend for the rest of the week.